Good morning, options traders. Well, this is the week of March 23rd, 2020. And I normally don't put dates on the videos, but it's important to understand about the time period that we're in for right now, the coronavirus pandemic. And a lot of traders are asking about strategies, hedging strategies that they can use for those who do wish to try to trade markets like these. Now, a lot of times I hear traders talking about levered ETFs or ETNs and using a dollar cost averaging strategy. But that can really lead to devastating consequences in a shorter period of time. There's another strategy that most traders don't know about called a constant dollar averaging technique. And this is a much better strategy for markets where you are expecting prices to go sideways, but just have a lot of volatility. So let's take a look at these two strategies. Let's start with a dollar cost averaging strategy, and I think most people have heard of this. It's where you're going to buy a fixed amount of dollars at fixed times. So for instance, you might buy $500 in every week or $100 every month. It's just a fixed amount of money at fixed periods of time. This is what a lot of employees do with things like 401k plans. Take a percentage of my check, dump it into the company plan. That's a dollar cost averaging strategy. And it can be a really good one if there is a long-term upward bias, which there is in the long run. And the advantage is that your average purchase price will be less than the current price. And that's just because you're picking some up high, some up low, but on average, in a rising market, your average price will be below the current market price. But again, this requires a long-term upward trend for this to work. And part of that reason is that if you think about it, your total is increasing. So if you put $500 in the first week, you've invested $500. In week 2, you've got $1,000, then $1,500, then $2,000, and so on as time goes on. That fund is getting bigger and bigger. And if prices fall at some point in the future, you could potentially be setting yourself up for a very big fall. But again, if we're going to assume that there's a long-term upward bias, dollar cost averaging is a beautiful way to not have the unfortunate time that the moment you stepped in was right at the high. It captures the average. So what's a constant dollar averaging strategy? Well, what you're going to do here is you're going to pick an average amount that you're willing to invest. So let's say that you have maybe $10,000 to invest today, and you think it's a good idea to buy an ETF for the next 30 or 60 days during this coronavirus pandemic, and you want to just kind of average into it. Well, rather than using a dollar cost averaging strategy, what you could maybe do is pick a proportion, let's say $5,000, and maybe keep $5,000 in cash. Now again, you could split these up. You could say I want to invest $7,000 and maybe keep $3,000 in cash, but it's usually best to split it. So in this example, your average is $5,000. That's your target. And like most targets, it's not going to be right there in the center every single time. And what you're going to do is to come back at fixed periods of time, and the more volatility, the more often you'll want to revisit it. So maybe a market like this could be even every day. But let's say even if it was every week, you check the value of your fund or of your holdings, and if it's below 5,000, or if the price of that asset is down, you're going to buy to bring it back up to your target price of 5,000. And if the price is up, let's say it's worth 6,000, you're going to sell $1,000 worth and bring it back to 5,000. You're trying to keep that $5,000 amount constant. And the beautiful thing about this is that it always leads to gains. Now, before you get too excited about that, let me re-emphasize the caveats. The first one, it assumes that you have cash to continually invest when prices are down. And it also assumes that prices are going sideways over time, not that they're continuing to go down. There's just a lot of volatility. And if that's true, it will always lead to gains. And the reason is, if you think about it, it forces you to buy low and to sell high. So when prices are down, you must come up with cash to take advantage of that. And when prices are up, it forces you to sell and to park it into cash, where we might redeploy it at a later time. So I know it sounds hard to believe, but let's go over to an Excel spreadsheet and take a look at both of these strategies. So here's an Excel spreadsheet, and I've got a couple of little models here. Over on the left we have dollar cost averaging, and on the right we have our constant dollar averaging strategy. So let's do the dollar cost first. We're going to go through 12 purchases. This could be 12 days, 12 weeks, 12 years, whatever, but these are just the times that we come in to do our purchase. And on the first purchase here, the price was 105. We're going to dump 500 bucks into it. You pick up 4.76 shares. Second purchase price drops to 104. You put $500 in, and so on. Well, when you get to the end, this is your average price. These are the total shares that you've accumulated. That's just the sum of this column. You've invested $6,000. That's just the total of all of the money you've put in. And here's your gain and loss. We've lost actually $182 because the fund's value is now $58.17, and that's found by taking the price times the number of shares that we own. So we lost about 3%. Of course, if we run a different scenario, and we'll do some in a moment, we'll get different prices and we could get different outcomes. So for right now, let's go ahead and try that. I'm going to hit F9 to recalculate these. And what I've done is I've actually told Excel to give me a random price between 95 and 105. So the average price is 100, but we're just fluctuating plus or minus 5%. And now we're down $6.70, about 0.1. Now we're up 311 bucks, up 5%, down 216 bucks. We're up, we're down, down, up. You can see that we kind of oscillate back and forth between gains and losses. And again, the reason is that for the dollar cost averaging strategy to work, it requires a long-term upward bias in price. And by the way I've done this, I've kept the prices on average at 100. So if that's a market that you're in, I mean, you shouldn't be expecting a long-term upward drift over the next month or so. If you're trying to play the ETFs and ETNs in this market, you should expect a lot of volatility. And you can see that if you're just getting a lot of volatility, that the performance is either not that good, even if it is green, or there's not too insignificant chance you're going to end up in the red. So that's the dollar cost averaging strategy. How would the constant dollar strategy have fared? What we're going to do is to take an average amount. And the way that I've figured this out is to say what's the average amount that this investor has put in, so that way we're comparing apples to apples. So if he's put 500 here in month 1 or in time period 1, and he's got 6,000 invested down here, on average he's got $6,500. We divide that by 2, that's $3,250. So this person's going to keep his target at $3,250. And when the price is 105, he's going to pick up almost 31 shares right here. Then the price in time period 2 drops to 100. His value is $3,095, so he's lost a little bit, right? It was worth $3,250. So the strategy says you need to bring this up to $3,250. So he's got to put $154.76 into it. That's going to buy him 1.55 shares at this price. And he now has a total of 32.5 shares. And notice that none of it has been parked in cash because he had to come up with more cash on the side. Now we go to time period 3. It's fallen again. Value of his fund is down below $3,250. He puts $97.50 into it, buys a little over a share. He's got 33.5 shares, and so on. Look what happens in time period 5 when it goes up to 104. Now he gets to sell shares. The value of the fund is $35.20, so he's going to sell $270 worth. That's what this minus sign means. He's going to sell 2.6 shares. He's going to have 31.25 remaining, but notice that he's parked nearly $71 in cash. This is what makes the strategy work. It forced him to sell when prices were high, and he might bring this cash back in at a later time. And so anyway, it goes on and on through the list down here, and at the end he has spent a total of $32.20, almost $32.21. That's just the sum of this column. Now sometimes this number is going to be bigger than what he started with. And again, that's part of what makes this strategy work, that you have to come up with the cash on the side when it's needed. And he also has $596 in cash. That's the sum of all the times he was able to sell some shares. So his total shares are almost 31. The fund's value is 3250, which is by design. That's mathematically how it should work, because that was his target up here. So if you take the number of shares times the current price of 105, comes up to right to 3250. But he's got 596 in cash right here. So we add those two figures together, his value is 3846, but he's invested a total of 3220. He's up $625 or 19.4%. So now that you understand how this is working, let's hit F9 and recalculate this and watch what happens. Notice that this guy over here on the right is never in the red. And in fact, his returns are quite impressive. It will never go red. It can't. And that's because it forces you to buy low and sell high. See, over on the left, you're just continually buying. You're never divesting those shares when prices are high. Now again, if we assume that prices are rising, yes, dollar cost averaging can work. Now, the bigger the volatility, the worse this guy can do on the left, and the better this guy can do. So for instance, let's come back up here to Excel, and I'm going to change this from a random price of, let's say, 95 to 105. Let's get crazy with it and do 70 to 130. So we're going to go plus or minus 30 bucks. Again, the average is staying at 100, but plus or minus 30. So now when things are going well, yes, our dollar cost averager can do well, but he can also still get into the red quite easily. But look at the guy who's doing the constant dollar averaging. Serious gains. And that's because there's more volatility. But as before, he never ever goes red. And that's because prices are going sideways just with a lot of volatility. So again, it shows and emphasizes the importance of keeping that average value, that target value right there. Forces you to buy low and sell high. It's a beautiful strategy for markets like this, or certainly much better than dollar cost averaging. So for those of you who might be trying to build some positions down here, something to take into account. Now here we actually got a red. That's more from rounding. You can see that the total cash that he's invested is $44.30 and the fund's value is here. This is just from rounding, but that would be the worst case, is that you just break even. This would be extremely rare, but it could happen. But you can see that it's always going to stay green. It has to by design. So this is the constant dollar averaging strategy, a much better way to go about markets that are highly volatile when we don't have time to look for an upward drift. Now for one last thing, when does the dollar cost averaging strategy shine? Well, that's going to shine if we have an upward bias. So let's make this number 100, and then I'm going to make this one, let's see, let's take this number times 1.30. So we're going to make it rise. Of course, this is not going to be in a week or a month, but let's say that we have this long-term upward drift in prices. Well, yeah, this guy is going to certainly outperform because he's putting more and more money into it, into a rising market. So now look, he's got $31,000. This guy over here has $21,000. But he's also got 1.81 shares. All he's doing is selling off his shares. Look at this, all sales. He's never putting more money into it. So if you watch in a case like this, that if we were to try lots and lots of different scenarios, the dollar cost averaging strategy is absolutely going to beat the constant dollar strategy hands down, because all you're going to do in this case is just sell off your shares. So those are some things to consider. I hope it gives you some things to think about for markets like this. So again, it's for anybody who is trying to use, especially with levered ETNs, and you're trying to just go in and out, rather than trying to pick the time that you think is best, try the constant dollar averaging strategy. And if we get average sideways prices but a lot of volatility, it's going to absolutely dominate dollar cost averaging. Now, just to be absolutely perfectly clear between these two strategies, if either of these are being used and the market continues to do nothing but fall, both of them are going to lose. There's no question. So let's say that you're using the constant dollar strategy and it just continues to fall and fall and fall, and you say, I just can't take the heat anymore and I'm going to stop. Yes, you're going to end up with a loss. But remember what the assumption is, that prices are going sideways just with a lot of volatility. So I've heard a lot of traders saying that that's what they think. We're getting a lot of bouncing through here, but probably just going to be overall sideways prices with a lot of volatility. And if that's your assumption and you're trading these levered ETFs or ETNs, consider using constant dollar averaging strategies, and it will give you a much better mathematical edge. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsa2z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.